This segment is on developing a budget for your business. Now, if you're a startup business, you don't have any numbers. So the first step is to develop a business plan to calculate where your income is going to come from and from where. You also need to figure out where your expenses are going to be and all the different line items that you'll be spending your money on. But if you're an existing business, you have some historical numbers to use and then to look at and re-examine and determine what's going to be different going forward. This is an Excel spreadsheet, and there are different worksheets at the bottom. This particular one is called Sample Cash Flow. Now, we have put in calculations so that the rows and the columns add up. You would put your name of your business here and the revised date. Every time you change any of the numbers here, it's always a good idea to put the date so you know you're working with the most current worksheet. This particular budget has the calendar year across the top, which you could do any way you want. If your calendar year starts in July to the end of June. Income is always reflected at the top, and expenses are always reflected below income. The idea is to identify all the different ways income rolls into your business. In this situation, we have retail sales, wholesale sales, and custom orders. Now, you could reflect different products. You could reflect different customers. This is important to how you want to evaluate your business and track the changes over time. For this conversation, we're going to focus on retail, wholesale, and customer orders. And you can see that numbers are in certain months and not others. Different times of the year. Regarding expenses, it can go on and on. You want to reflect all the expenses that you anticipate in your business and plot them in the different months when you think they will occur. And then we'll give you, our worksheet will help you, it'll tabulate across and it'll tabulate down. So here we've got $367,355 in income coming into the business over the year, and $229,060 of expenses going out. This line, our cash balance, is the difference between our income and our expenses. So we have $138,295 profit at the end. Wouldn't that be nice? Boy, that would be pretty neat. What I like most about this type of a cash flow is what's underneath the cash balance, which is the list of all the assumptions that are up above in those numbers. So let's look at a couple. Income from retail sales assumes steady sales from the previous year. Income from wholesale sales assumes last quarter sales from a new product. Oh, so that's why at the end of the month, end of the year, there was new numbers in income. And then income from custom orders assumes sales from a private label customer. Again, new information, maybe a new product. All of this information is probably explained in the business plan. Under expenses, we've taken all those line items from above and listed them out here. Advertising assumes expenses spent on what item in which month. So if you're buying t-shirts or business cards, you're reflecting those in the particular months up above. Now, auto expense assumes an average of 200 miles per month in the first quarter at 56 cents per mile, which is $112, and then 300 miles in the second quarter, which will be $168 per month. So you can tell there's something different that's going to happen during the year. Bank charges assumes an average of $10 a month. Contributions assumes $100 of donations, dispersed $25 quarterly. Credit card fees assumes $40 yearly membership in August. And dues and subscriptions assumes business association dues of $130 and then trade association dues of $300 annually. Finance charges assumes a credit card expense of $200 a month in the fall until the cash can be covered by paying off the credit card in full. General insurance assumes general business liability with $1 million limit. Insurance workers' compensation for 4 employees. Now you're starting to get a picture of what's going on in this business this particular year. License and permits assumes business permits that might happen annually. Office supplies assumes paper, ink, general supplies for the administrative uses. Here we have an owner's draw, which assumes a salary for the owner. Here we have payroll tax expense, which assumes a 0.156% of all wages related to payroll. And this is the calculation that we're using. Professional fees assumes a bookkeeper and a CPA. Rent assumes monthly payment, and this is a 2-year and a 5-year lease. So by looking at this, I know what's left in that lease. Repairs and maintenance assumes repairs for whatever equipment you're purchasing, and you want to make sure you capture all of those big expenses. Salary and wages for 2 full-time employees and 2 part-time staff. Now here, look how this breaks out. 2 full-time at $10 an hour, 38 hours a week, 4 weeks a year. They're paying $3,040 a month for those 2 full-time employees. And for the 2 part-time employees, it's $8 an hour, 10 hours a week, 4 weeks a year, $640. So together it's $3,680 a month. Of this monthly wage, we're going to come up to here and use this formula to take 0.156%, and that's going to be allocated out for payroll expenses. All right, moving on, we're going to have shipping for all those wholesale orders. We've already calculated about 2% of our wholesale orders are for shipping. So we have another calculation that's going to be reflected on that line item. We're going to have small equipment purchases we're going to keep track of, and we're going to have supplies. Now, these supplies are related to all of the materials that it takes to make those products that are being shipped out up above in retail and wholesale sales. And we're going to assume that 30% of those expenses are directly related to our cost of goods for those products. Of course, we have taxes, and we want to capture our taxes. So here we've got our retail sales are going to have sales tax, so we're going to take money out for that. And here's our calculation. So all the money that comes in under our retail sales line, we're going to capture 6.24% and know that we have money aside for our taxes. We have telephone and IT each month. We have utilities, we've got loan expense and interest expense for any debt that we've incurred. So once you've described all your assumptions, it tells you what's going on in that business over time. So if we go back up, we can then revisit the steady sales from the previous year that we're assuming will happen, the new product that will be delivered and sold through wholesale sales at the end of the year, and we have a little bit of business from a private label customer. If that happens in this way, we should have $367,000 in sales. And if we look at our expenses and we pick out a particular number, we've got our rent, right? We already know what our rent is because we've got 2 years in our lease. Here's our salary and wages. And here's our payroll expense. Here's our telephone. See, it all tells the story. So the idea is that we've got our income, we've got all of our expenses, and then we've got the difference of each month, what's going to happen. And wouldn't it be nice to end up with $138,295 in profit? But if it doesn't, and we end up with less money at the end, then we might have to cut back on some of our expenses. We might have to add sales so that we have a balance at the end of the year, and because the goal is actually to have a profit. But you can't get there until you've got your numbers and your strategy in place so that you can sit back and look at it and see how this is all going to work for the 12 months you're projecting.